What if the next big stock winner costs less than your lunch? Imagine turning a $2.70 investment into a fortune, just like early investors did with Netflix or Monster Energy. Today, I'm revealing 3 stocks under $15 with massive upside potential. Companies flying under the radar, but with strong fundamentals and real growth engines. So hit that like button, subscribe, and share this with someone who's ready to level up their portfolio. Let's dive in. Low price doesn't mean low value. Mansion or money pit? That's the game you play when buying low price stocks. They can either skyrocket or sink. But history shows that some of the best investments ever made started off cheap. There's a sweet spot in the market where overlooked stocks, often trading under $15, can yield life-changing returns when backed by real fundamentals and strong management. The reason is simple. Many institutional investors avoid these stocks due to size, volume, or past performance. That leaves room for everyday investors like you to act before the big money arrives. Once the fundamentals improve and Wall Street catches on, the price often follows, fast. But you have to get in before the crowd. Let's rewind and look at some real winners. Palantir PLTR was under $10 in 2020. Today, it's up more than 200%, driven by government contracts and AI momentum. ELF Beauty, once just another budget cosmetics brand, traded below $5 and went on to deliver nearly 10x returns. SoFi, another stock on our list, started under $10 and is becoming a fintech juggernaut. These are not isolated cases. They're proof that undervalued doesn't mean underperforming. Even large-cap success stories like Amazon and Apple once traded under $15. What matters isn't the price of the stock, but the value behind the business. If a company is building real value, solving real problems, and improving its financials, then the current share price might just be a temporary discount. Low-price stocks often come with high volatility and skepticism from institutional investors. They're ignored because they're small or new or in turnaround phases. But that's exactly what creates opportunity for retail investors like us. The real challenge is separating the undervalued gems from the junk, finding the mansion, not the money pit. The idea is not a gamble, but to take calculated risks based on improving fundamentals and future potential. If you can do that consistently, your portfolio could outperform the broader market over time, even with smaller positions. In today's video, we'll reveal 3 companies under $15 with clear catalysts for growth. These aren't random penny stocks or speculative tech bets. They have strong leadership, improving financials, and scalable business models in large markets. If you're patient and strategic, these stocks could be future giants in your portfolio. They may not be household names yet, but if they continue executing, they could become the next breakout success you'll wish you had bought when they were still flying under the radar. The 3 stocks under $15 with big potential. 1. The Honest Company, HNSD, $4.40. At first glance, the Honest Company doesn't look like a game changer. It sells diapers, lotions, soaps, basic, everyday products. But that's the beauty of it. Boring businesses, when executed well, often become cash cows. Just ask investors in companies like Clorox or Colgate-Palmolive. Honest targets 2 booming sectors: clean baby products and natural beauty, both of which are seeing massive consumer shifts toward transparency and sustainability. What makes this more than just another brand is the emotional connection it builds with its customers. Parents are increasingly selective about what they use for their babies. Millennials and Gen Z are driving demand for clean label products. Honest is in the right place at the right time, offering peace of mind and convenience in categories where brand loyalty is strong. Founded by actress Jessica Alba, HNSD positioned itself early as a clean brand champion. What's changed recently is the business model. Under new CEO Carla Vernon, formerly of Amazon and General Mills, the company has made impressive strides. Gross margins have jumped to 36%. Net income has turned positive at $3.2 million last quarter, and they hold $73 million in cash, with 0 debt. That's rare for a small-cap consumer brand. And unlike many startups, Honest isn't burning through cash to grow. The company is now focused on sustainable profitability, optimizing its product mix, and scaling efficiently. This is a phase where real investor returns are made, when a company turns a corner from vision to execution. The market cap today is around $400 million, tiny when compared to their total addressable market. If the company can reach $50 million in annual profit, it could easily justify a $1 billion valuation, more than doubling your investment. If they hit an aggressive $150 million profit target, you're looking at a $4 billion valuation, a potential 8x to 10x return. And those numbers aren't as far-fetched as they sound. With smart cost control, brand expansion into new categories, and stronger retail partnerships, hitting those profitability levels is within reach. This is what makes Honest a compelling long-term value play. Compared to giants like Procter & Gamble or Kimberly-Clark, Honest trades at a fraction of their valuation multiples, yet targets a faster-growing segment. While those blue chips focus on volume, Honest focuses on premium, margin-rich products. This gives an edge in brand loyalty and profit scalability. The bottom line? This isn't a moonshot. It's a grounded, brand-driven business with strong upside. Investors who want exposure to consumer staples but with growth potential should take a hard look at HNS. It could be the next big brand in clean beauty and parenting essentials. 2. SoFi Technologies, SoFi, $13.00. SoFi is one of the few true fintech ecosystems available in the public markets. It began as a student loan platform, but has since evolved into a digital bank, offering savings accounts, investment tools, personal loans, insurance, and even crypto. With over 11 million members and a user growth rate of 52% per year, it's building a sticky, comprehensive financial platform that appeals especially to millennials and Gen Z. This isn't just a financial app. It's a lifestyle platform for money management. By integrating multiple services into one seamless experience, SoFi builds loyalty and cross-sells efficiently. Every time a customer takes out a loan or opens an investment account, the lifetime value grows. That's how you build a bank for the next generation. But what sets SoFi apart from other fintechs is its bank charter. This allows it to hold deposits and lend without relying on third-party banks, keeping more profit in-house. Their most recent earnings report showed a $71 million profit, strong net interest margins, and an improving loan book. This is not just hype. It's real, measured financial progress, which is essential for long-term success. Having a bank charter gives SoFi the flexibility and regulatory advantage most fintechs can only dream of. It means they control their financial destiny while reducing risk and increasing margin. That's why the next phase of growth could be even more explosive. Led by Anthony Noto, former CFO of Twitter and managing director at Goldman Sachs, SoFi has a leadership pedigree to navigate both tech and finance. He's focused on disciplined growth, customer acquisition, and product innovation. In the fintech world, execution is everything, and Noto's track record speaks volumes. Noto is also investor-friendly. He understands capital allocation, long-term vision, and market sentiment. Having a CEO with Wall Street credibility matters, especially when SoFi begins to attract more institutional attention. There's also merger and acquisition potential here. Traditional banks are struggling to attract younger users and keep up with digital trends. SoFi has already built the infrastructure and a loyal user base. That makes it a prime target for acquisition by a larger institution wanting to modernize quickly. With its $13 share price, SoFi still trades at a startup-like valuation, despite having real bank-grade fundamentals. In the next 5 to 10 years, SoFi could evolve into the next major financial institution without the physical branches. The upside from here could be substantial for long-term investors willing to weather short-term volatility. 3. Fubo TV Fubo, $2.70. Fubo TV is a classic high-risk, high-reward opportunity. At just $2.70 per share, it's easy to overlook. But Fubo is uniquely positioned in a massive, rapidly changing market, sports streaming. Unlike Netflix or Hulu, Fubo focuses entirely on live sports, one of the few content categories people still watch in real time. That makes it extremely valuable to advertisers and users alike. And sports aren't going anywhere. Whether it's the World Cup, NFL, or MMA, fans want live access, and they're willing to pay. That demand gives Fubo leverage in pricing and partnerships. With streaming dominating traditional cable, Fubo has a unique angle that few platforms can replicate. Fubo is not just surviving, it's growing fast. With $416 million in revenue last quarter and losses narrowing each quarter, the company is showing it can scale. It also has $321 million in cash, a strong buffer for a company with a sub-$1 billion market cap. This financial flexibility gives it time to optimize operations and invest in customer growth without constantly issuing stock. Their path to profitability looks increasingly realistic. As customer acquisition costs drop and subscription bundles improve, Fubo could hit a positive EBITDA runway sooner than expected. Partnerships with giants like Disney, which brings ESPN and Hulu into its ecosystem, strengthen its competitive position. And their plan to launch a skinny bundle streaming package at a lower cost is perfect for budget-conscious sports fans. If executed well, this could pull market share from YouTube TV and traditional cable providers quickly. More than just content, Fubo is integrating sports betting and live data to create a next-gen fan experience that could unlock new monetization channels well beyond traditional advertising. Globally, live sports content remains premium. Fubo is expanding internationally, including Europe and Latin America, markets hungry for soccer, MMA, and more. If it captures just a slice of that audience, the long-term revenue potential becomes massive. Remember, DirecTV was once valued at $67 billion. While Fubo won't match that anytime soon, even 5 to 10% of that kind of valuation would be a 10x return from current levels. If you're comfortable with volatility and want exposure to the future of live entertainment, Fubo deserves a spot on your watch list. It's speculative, but the upside is real. Insights and strategy. What smart investors know. Here's something most amateur investors overlook. Boring businesses often produce explosive results. Companies like Monster Energy or Deckers, maker of UGD boots, seemed uninspiring, but their predictable, cash-generating models turned early believers into millionaires. The lesson? Flashy doesn't always win. Steady, scalable models do. These types of businesses focus less on hype and more on execution. They often build defensible moats, have loyal customers, and operate in markets that are less crowded by venture-backed competitors. That's how they grow steadily and quietly, until everyone wishes they had gotten earlier. What these companies all have in common is strong leadership. Carla Vernon is transforming Honest into a focused, margin-driven machine. Anthony Noto is building SoFi with military precision and Wall Street expertise. Even Fubo's leadership is tightening financials while forging bold partnerships. A good CEO doesn't just manage, they multiply value. Leadership creates the culture, sets priorities, and defines how capital is used. Great leaders in small companies can make the difference between mediocrity and massive returns. Always research the person behind the company as much as the product. But let's be real, low-price stocks are risky. They're often thinly traded, misunderstood, or in early growth phases. That's why due diligence is key. Look for improving revenue, shrinking losses, growing margins, and management execution. And always consider position sizing. Don't bet the house, but don't ignore the upside either. These stocks should be part of a diversified approach. Use them to complement core holdings, not replace them. When they work, they really work. But the goal is to win smart, not win fast. The most successful investors treat stocks under $15 like venture capital bets. Small, calculated risks with asymmetric returns. If just one of these becomes a 10x play, it can cover the losses of others and still deliver outsized gains. The key is to think long-term, stay informed, and let the numbers, not hype, guide you. Always remember, success in the market isn't about finding magic. It's about finding value early and staying consistent. Your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth-building strategies.